Let's learn all about corporate bond funds from our fund manager Anand Nevatia.
So debt markets have been in a bit of a turmoil since the onset of COVID-19. We've seen a lot of volatility that has come across in these 2 to 3 years. Also, what has happened is since RBI tried to support the economy, they had cut rates very aggressively. It's only since April 2022 that RBI has started hiking rates in its efforts to control inflation. So what had happened in the earlier times, that is from 2020-21, the returns from debt markets were quite low. However, with these changes which are coming from the Reserve Bank of India and central banks across the globe, we are able to see better returns coming from debt markets. It's a very good time for all debt investors to start or to increase allocations towards their debt funds. Corporate bonds are typically loans which are issued by corporates, but instead of taking them directly as a loan from bank, they come in the debt capital markets and issue bonds to investors. These corporate bonds in turn are then bought by various investors, which could be banks, mutual funds, insurance companies, and even individuals. Corporate bond funds are a new category of funds that came in since SEBI brought in the categorization of schemes in the mutual fund industry in 2018-19. The key advantage of a corporate bond fund is that they have to have at least 80% of their investments in corporate bonds which are rated AA plus and above. This ensures very high quality portfolio as per the SEBI mandate. The balance 20% goes into other instruments. However, a 10% liquidity requirement also is mandated by SEBI, which brings in an additional layer of comfort on the corporate bond portfolios. Corporate bond fund brings in the element of high quality in an investor's portfolio. It brings in a stability of the income or a stability of the investment in the investor's portfolio. These funds are ideal when the investor needs to invest for an extended period of time in debt funds. The question of how much should you invest in a corporate debt fund depends largely on your risk-taking appetite. People who are looking, or investors who have lesser risk appetite and at the same time need a high accrual income, should allocate a good portion of their debt allocations towards corporate debt funds. The debt markets after a long time are showing very healthy portfolio yields. For investors who have inclination or who should invest into debt market through mutual funds, it's a very good time, especially because not only are we going to see very high accrual yields from corporate bond funds, or even for that matter broad category of funds, but there is also a good scope of capital gains going ahead whenever RBI decides to start cutting rates again. Investors should use debt funds as an appropriate investment vehicle or an appropriate investment option in their overall portfolios. Debt funds bring in a lot of stability and also an assurance in terms of accrual income and at times potential capital gains. However, depending on the risk appetite, the choice of funds can be made. The risk appetite, if it's slightly higher, investors can look to get into duration exposure also, which is taking exposure towards long duration funds. Debt investments is a very simple process if one has one's thought process clear. All one needs to do is take a call on the amount of risk one wants to take through either credit or through duration. Once that is decided, one can choose from the various funds and schemes which are available to appropriately match one's risk appetite. A key thing is that one should not try and take extra risk through debt funds to generate extra alpha. That is the key point one should keep in mind while investing in debt funds.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.